But let's talk about what really is going on with the surging yields and what kind of risk does it really pose. We have with us Bhaskar Panda from HDFC Bank joining in on the show. Bhaskar, hi, good morning. Good to have you on the show. The US 10-year yield, Bhaskar, has now risen to a 14-month high. And this despite the US Fed assuring near zero rates at least at 2023. What, according to you, then, is spooking the markets back in US?
Hi, good morning to all your viewers. If you look at the rally in US bond yields, it's been consistently happening for maybe at least a few weeks. So what the question now is that what the bond markets know that, say, for example, Fed doesn't know, or Fed knows and doesn't want to, wants to wait and work rather late. So what has happened if you look at the growth and the US growth as well as the inflation seen in US, you would definitely realize that growth is going to be robust post pandemic. And also the inflation is going to be, definitely higher than what it was. So if you look at the bond yields, that reflect the fundamentals. But what Fed has been indicating, and even the dot plot also has been indicating, that they are going to be tolerant towards this for a longer period to come. I really don't know how long they can wait or how long they can, tolerate higher inflation as well as other things. So we'll need to, see where this stops. But what we have seen recently is that in 10-year bond has actually, after touching almost 1.7475, has now retreated a bit. So maybe you will see the new range. Maybe you will see that it will consolidate around here. That's a hope, but probably that's going to happen.
Okay. Do you see higher inflationary expectations and perhaps a taper tantrum which could pose as a big risk to bond markets and equity markets?
See, higher inflation expectations is definitely there. At least personally, I believe that there is a higher inflation expectation, and that's going to remain with growth coming back, with the kind of money that we are, pumping into the system. It's obvious that the inflation could be, inching higher. With bond yields at higher levels, obviously the equity markets have been spooked a bit already, and probably will continue to consolidate on the downside. So I think that's what is going to happen. And now the next, next is where the oil goes and settles down. That is something which is very important for Indian point of view, because higher oil prices, meaning higher inflation, meaning, you cannot cut down interest rates, so on and so forth. So I think if these three remain where they are right now, or these three go according to the expectations, then probably we'll see a little bit of higher yields, not only in the US, but also here in India as well.
Okay. What's the outlook on the currency in light of some of these factors, Bhaskar?
On dollar rupee, I think what we have seen recently is that there has been a lot of support coming in around 72.40, 72.35, 72.15, these kind of levels from obviously the central bank. And we have seen very robust inflows because of IPOs hitting the markets this month. And if you look at our BOP situation, it has become better because maybe we are importing much less oil last year. So all these three together, had an impact on the dollar rupee. But right now, technically, if you see, if we are not breaking below 72.40 or 72.37, chances are that we should be, dollar rupee should be going towards 73.30, 73.50 in the near term. So that depends on obviously what's the kind of inflows that is going to come during March as well as after March also. So I think downside in terms of rupee appreciation is limited in my view, and upside is definitely there. That means a little bit of depreciation is in store for dollar rupee.
All right, thanks for that, Bhaskar.